For more on how the economy is doing, we're joined by economic strategist Frances Stacy, wealth manager for Scarlet Oak Financial. Frances, welcome to the show. First, your reaction to the new inflation and spending data. What does that tell you about the state of our economy?
It's starting to deteriorate. It's very interesting because Trump is, on the one hand, he's touting the golden age and he's touting this new investment that's coming into America. But there is a lag effect to all of that. And right now, there's just a lot of nervousness and concern. Today was the second worst day in the market as far as the sell-off. The things that worked today were very defensive: utilities, gold, volatility was really up, and treasuries. There is something with the Trump administration where they are actually probably not minding a little bit of a market sell-off because it drives investments into bonds. And one of the key risks on the table with these tariffs is less demand in the treasury markets, and especially from our foreign allies.
We also got new consumer sentiment report today. It's down 12% since March, down 30% since Trump was elected in November. How much does that tell you about where things are headed?
There's a lot of risk on the table because basically so all of the leverage that Trump is using for his tariff talks and negotiations is that so much of the world is reliant on the U.S. consumer because we consume the most. And his Treasury Secretary has been careful to point out that the top 10% in our society consume 40 to 50% of all consumption. And that's, that says that the bottom half is really hurting. The risk here is that when people stop spending, it puts a little bit of a freeze in demand on the economy, and it affects our growth. And the S&P 500 out of Apollo today with some great data. If you have a 10% drawdown in the S&P with a recession, you have a bear market. If you have a 10% drawdown without a recession, you don't tend to have a bear market. And so we're watching those September lows at 5,400, but this stopping the spending puts a little bit more risk of recession into the equation.
And you know this as well as I do. All of this is coming out before Trump's latest tariffs go into effect next week. How soon could we see an impact on those prices?
Well, the thing is markets are very anticipatory, so it's trying to price in. The money supply, despite, the promises of cutting spending and everything like that, the money supply is actually up since January. And usually the S&P 500 is correlated with the money supply. But the market right now is trying to price in the tariffs, the fiscal cuts that are coming, et cetera. So those have separated a little bit, and they are going to marry each other again. Either the S&P is going to trade up to the M2 money supply, no recession, or the M2 money supply is going to come down to meet the market.
The president says the tariffs are worth a little disruption for the long-term goal of bringing manufacturing back here to the U.S. Here's how a researcher at Deutsche Bank summed it all up. The more you listen to the current U.S. administration, the more you appreciate that they are prepared to sacrifice near-term market performance and economic growth if it's required to meet their longer-term objectives. How long, Frances, could it take to see this pay off? We keep hearing short-term pain, long-term gain, but how long?
Yeah, I don't know how long, but I'll tell you the real problem that we're facing, and Ray Dalio, founder of Bridgewater, covers this the best. You can find it on YouTube. We have got to reduce our deficit spending from 7% to 3%. It's about 7.5% now, to 3%, or we're going to head off of a debt cliff statistically and mathematically. And the problem, if we head off a debt cliff, nobody's going to want to buy our bonds. If nobody buys our bonds, it will not finance our government. So they are letting the market sell off with the hopes. Didn't do it yesterday when the market sold off, but today money really went into bonds. And then those bond prices are going to get more valuable and move higher, which is going to bring more investment into bonds. It's going to lower yields, which is going to put less pressure on people suffering from high yields, high interest rates. And that's the play, is let the market sell off and get that demand back in the bond market.
And like you mentioned, a lot of the markets are already anticipating these movements. Frances Stacy, thank you so much.
Thanks so much for watching. Just go to joinnn.com to find NewsNation on your television provider. And don't forget to click the red subscribe button below to get more of NewsNation's fact-driven, unbiased coverage.